Maybe that's why people prefer Twitch so much to streaming on YouTube.
All right, I think we are live.
Oh yeah, we are live.
We are live. All right. I'm just going to post this on Twitter real quick.
Yeah, sounds good. Actually, I can do that. Also,
All right. I think we are good to go. We'll just give it a minute here, or, maybe another 30 seconds. I posted it, so we'll wait for some people to come in.
yeah, sounds good.
The first comment is when moon.
uh,
All right. There's a few people, so I think we can get started. So what's up, guys? Welcome back to DCA. I have Mark with me again from Upside Down Data. We're basically going to take your questions. We're going to talk about a few things, but I think it can be pretty open. If you guys have anything you in particular want to discuss, we could go over that. So let's do it. Oh, you guys are hearing an echo? Naturally.
oh. Let's see.
Are you still hearing an echo now? All right. Well, need to bring out the big guns then. Let's change this. All right. How about now? Are you guys hearing an echo still? Of course, there's a lag, so you have to ask the question and then. All right, cool. I think people are saying it's good now. So let's go ahead and do it. All right, there we go. I'm just switching my speakers. All right. So I guess, what do you want to start with, Mark? We could talk about, we could go a bunch of different ways from here, but, you know, I think the number one thing we could start by talking about is kind of what you think about what's coming up for the market. What are, you know, what should people out there, the retail market, what should they be expecting in terms of just price action from your perspective? Hey, Mark, I'm sorry. You're muted now. This is, we discussed not having any audio technical difficulties when I mean, we can't have one of these without, yeah. Sorry guys. Give me 1 second here. All right. It's if it's a Monday, well, every stream is a Monday then, because we have not had a single stream yet without without having the first 10 minutes of the stream being audio technical difficulties. Are you guys able to hear Mark now? And we'll awkwardly wait 15 seconds because there's a lag between us and, oh no, they can't hear you. Interesting. All right. Well, let's see. Oh, I know why. Okay. I think this should do it. All right. How about now? Can you hear
Okay.
him?
Can you hear me now?
This is riveting stuff here.
Okay, excellent. Awesome. All right. Thanks for bearing with us, guys. So yeah, so going back to the question then about kind of what I'm expecting from price action, you know, I'm really, what I was starting to say is I'm really seeing, you know, as has been the case for a long time, macro driving the ship. And so really for me, my expectations about price action are very much dependent on what I see happening in the macro space. And obviously the two big narratives that are out there right now are inflation and recession. And it's kind of an interesting combination because they kind of in some ways go together, depending on what happens, and they kind of go opposite to each other in some ways as well. And so I think the most bullish thing for the market that could happen would be if we see a pretty steep drawdown in inflation numbers for whatever reason. I mean, we have seen commodity prices start to fall off a cliff a little bit. You know, oil prices have been plummeting. A lot of other commodities have been plummeting as well. And so there's some signs that there might be some easing on inflation. But one of the reasons a lot of people have pointed to for why that's happening might be fears of a recession that's coming up. And of course, in a recession, if you have, you know, earnings dropping off a cliff, that can really do a stock market draw down even further than what we've already seen, which could then draw prices down further. So I think for the market to actually get bullish, we'd have to see a kind of, I don't want to say unicorn, but a kind of very specific combination, in my opinion, where we see inflation fall off really heavily and we'd see earnings stay relatively high in the equities market or for, you know, within the equities market. And that might then allow the stock market to really rally. And I really think we'll need a healthy stock market to see crypto be able to start moving back to the upside. I just think that correlation is too strong right now, too much of a risk off environment right now for us to see equities to be falling and to see crypto ripping, at least in my opinion. And so that's one of the factors I'm looking for. And if we don't see that, if we do see a big drawdown in the equities market, I actually put out a video the other day where I, just using regression, just looked at if we saw a 2008 style drawdown in the NASDAQ, what would we expect Bitcoin to do in that environment? So if we saw another, I think it's around another 30% downside on the NASDAQ from where we are right now, what would happen to Bitcoin? And what that model suggests is that we'd see Bitcoin all the way down to about $3,500, so 3.5K, which I think most of us, to think of a 3.5K Bitcoin now is pretty shocking. I don't think most people would see that as being absurd, but that's just given the correlation of Bitcoin to the NASDAQ right now, that's actually what you'd expect. So that would be my more extreme kind of worst case scenario, is that if we do see a full on 2008 style crash in the stock market for whatever reason, if inflation stays high, if earnings drop off a cliff, etc., it could get really bad. We might look back at a 20K Bitcoin and say, man, I wish we could have those days back. Now, it's not necessarily my base case. I don't know if that's any more likely than the other scenarios, but if we're just looking at kind of the range, that's the way I see it. And I think probably most likely we'll end up somewhere in between, right? I think that it's probably the case we're not just going to see an immediate recovery. I don't think we're probably going to get that kind of best case scenario I just gave. But I also think seeing a full 2008 style crash would have to see a pretty massive, drawdown. It'd have to be some pretty nasty recession we go into to see something like that. So those are some things I'm watching. Jay, I'm curious to hear your thoughts on that question.
Well, actually, let me elaborate on something you said, or ask you another question along those lines. What do you think about the scenario playing out where the debt servicing ratio to the GDP, as we're raising these rates, sort of becomes at a point where, we can no longer afford to make those payments. So the Fed is kind of backed into the corner where they have to decrease the rates because of the fact that the required debt payment as the rates are going up is sort of becoming intolerable or unsustainable. What do you think in that scenario? Because I've heard a lot of people mention that case and then sort of indicating that, and specifically I'm talking about some of the crypto YouTubers that ostensibly have economic knowledge, but they've been talking about that scenario where the Fed sort of has to back off the pedal as being a bullish scenario for the markets and for risk assets. From my perspective, that's, if you're having to back off of, you have to take your foot off the gas because of the fact that you can't make the payments because the debt in the United States is now greater than our, the GDP, and the debt payments are unsustainable. That to me is not a bullish case for anything. That's a death spiral for the economy and for, for debt markets and for the housing market and for, et cetera, et cetera. So what is your opinion on that scenario if the Fed has to back off because of the fact that the debt to GDP ratio becomes too high?
Yeah, I think that's a great question. And so I do think that it's, it certainly is possible, right? And I think the question is just how high and how long would it have to go before it really became so extreme that it had to pull back. But I do think it's a definite possibility. I think in terms of whether or not it's bullish or bearish, I think there's different ways of looking at it. I think kind of more long term, it's bad for the economy, certainly, like you were saying. Like, it's just, for example, if the U.S. had a default on its debt, it would be a catastrophe, especially because U.S. debt or U.S. denominated debt is the biggest kind of chunk of sovereign debt that other countries hold, and so it would be a disaster on a global scale. But when we specifically though talk about crypto, I do actually think there might be a bullish case, and this is where I see it being, where I think if we get into that scenario where we just can't service our debt because rates are too high, and then they have to go back into QE or they have to start pulling rates down to be able to not default, basically. What that means is that they're basically just giving up on inflation. They're just basically saying, whatever, like, it's just going to do what it's going to do. We're not going to try to stop it anymore, which means that we'd go into a situation where we have really high, just chronic inflation. And that's actually an environment where fixed assets can do quite well. So like back in the 70s, for example, gold and silver, there was volatility, but they had some of their biggest bull markets that they've ever had during this environment where the Fed wasn't willing to do what it took to really bring inflation under control. In that case, the Fed had the capacity to do it later on in the environment, in the situation you're talking about, it would actually be even worse, where the Fed wouldn't really be able to rein it in later because they literally can't. And that actually could be a place where something like Bitcoin or any other kind of crypto that can be considered a scarce asset could potentially do better, because people would be saying, well, basically fiat is going to just be incinerated. It's going to just be inflated away. And even if we do it in the worst case scenario where the kind of the economy collapses, you don't really want to have all your money locked up in fiat, because if that whole system goes up in flames, you're kind of screwed. So that would be the one situation where I'd see a unique carve out for things like precious metals and crypto, Bitcoin, etc., where people, whatever money is left, might just get funneled into those assets, because otherwise they'll be gone. But certainly I agree with you that it would be a catastrophe for everything else. And I think it would be a hell of a lot of pain. So I don't think it's anything that we should be hoping for, right? Because it would mean that a lot of things would break, but your bags would pump, would be kind of that scenario. I mean, I'm curious, Jay, if you have other thoughts, but that's just kind of my thinking through of what might the bullish case be.
Yeah, I mean, I guess the other side of the coin would be, are they still pursuing a plan of quantitative tightening, and are they pulling funds out of the market, or are they pulling liquidity out of the market? And so there's sort of an interplay between those two different scenarios happening at the same time. But I guess the way that I think about it is, perhaps that's putting us into a short-term bullish case, but how long is that sustainable? And how long is, I guess the Bitcoin maxis then would say, well, that's why we have Bitcoin. It's so that you can, have an asset that's not under the, not being influenced so heavily by inflation, and not waiting on the Fed to sort of change monetary policy to sort of align with what's going on in the economy. So I don't know what to think about it. To me though, that is, if debt is so out of control that we can no longer make the payment on it, I just don't see how that can possibly be a long-term bullish scenario. Now, maybe for Bitcoin, there's a case to be made, but I don't know how that's possibly bullish for, things like all these other altcoins that are out there that are sort of frivolous, more or less, in that regard, in that they're, I don't know. I guess I don't have a great answer for it, and I mostly wanted to get your opinion on it. I actually wish I did have a better answer for that particular question, but it's such a complex case now that there's so many sort of moving parts going on all at the same time, that I think I'm having a difficult time envisioning a bullish scenario for the foreseeable future, I guess, is what I'm getting at. You still have all of the supply chain issues, which even if those start to get resolved, that is not the kind of thing that immediately recovers. That is the kind of thing that takes months and months and months to improve. And that's one thing that people continuously don't talk about, is the Fed has no control over the supply chain issues. And people, in order to understand how inflation works, it's, one side of the equation is the money supply. How many dollars do people have out there? And as that's increasing, as the Fed is printing money to sort of bail themselves out, or, as they're printing money, and I don't know, that's a whole different avenue I could go down, in that printing money can sort of make the debt to GDP ratio, it can make that look better, because the GDP goes up as they're printing more money. And so it's sort of, putting themselves in a position where, well, the scenario doesn't look as bad anymore, but in reality, it's much worse than it previously was, because now you have hyperinflation to go with the fact that you're putting a Band-Aid basically on a hemorrhage. And so, there's the money supply side of the equation for inflation, and then you have the supply chain. If you have less goods and more money in the market, then you're in the situation that we're in now, where the quantity of money has been rapidly increased, and at the same time the supply on the market has been rapidly decreased, putting us in the situation we're in. So they can print the money to sort of get themselves or bail themselves out from that regard, but they can't make manufacturing in China start shipping goods over immediately if the manufacturers have all been shut down. And, if there's a war in Ukraine and Russia creating energy and food shortages in Europe, right? There's no way that, the Fed can sort of control that side of the equation. And so it just seems like there's so many different things going on right now that are sort of out of their control. And the things that are in their control, they're sort of, acting one step behind or, one or two steps behind what the market is doing, which is, more or less naturally what the Fed does. Historically, they're very inaccurate at predicting what's going to happen in the future. And so they're constantly playing catch up, I guess.
Yeah, exactly. And I think, one of the things I've heard people talk about is how we've gotten away with it so long is that there are a lot of deflationary forces kind of in the world right now. And, one of them is that, aging populations and smaller kind of workforces is an inherently deflationary factor. And also the globalized paradigm we've been in for the last, basically ever since like the 80s has been something that's just been massively deflationary because you can always just optimize for the lowest wages wherever in the world that is, bring it in. But I think one of the things that COVID did was it made a lot of countries in the world realize that you can't really rely on globalization in extreme circumstances. You need to have more control over your supply chains because, if suddenly there's this massive global catastrophe and you don't make any of your own microchips in your country, now suddenly you're completely, stuck. You're completely screwed for so many things that need it. And so I think that's this, in addition to everything else that's already going on, the pandemic and war, et cetera, that's this other additional force that's going to play out. And I think it's really going to be interesting to see how this all interacts because you're going to still have some deflationary forces, technology, aging populations, et cetera, but then you're also potentially not going to have the globalization that we've had in the past. So I think we're kind of entering uncharted waters to some degree from more recent context, which is probably why a lot of people's models are getting thrown for a loop right now, because a lot of it's based on the way things have worked in the last 40 years, but it's unclear if that's really going to continue. And so that's why I personally, in terms of making predictions for the future, I'm just kind of sitting in a place where I think uncertainty is in some ways the correct place to be, because, who can prognosticate accurately and say, yes, I for sure know that this is the way it's going to play out when we're basically entering into a context that we haven't seen. There's not really great analogs, at least in recent history. So that's just kind of my base case. And so that's where I kind of look at a range and just kind of how things are playing out will shift my probabilities of what I think is more or less likely. But I'm not going to really make too heavy of a bet on one way or the other.
All right. I have a question here from Safco. It says, do you guys ever see Bitcoin becoming more decoupled from traditional equities markets? Obviously, this has outperformed in the last decade, but do you see a time where traditional markets don't affect crypto?
Do you want to take that one first, Jay?
Yeah, sure. I kind of think that this idea that, at some point now, I guess it comes down to two different ways of thinking about it. The first would be that when we look at Bitcoin, if that starts to be, become valued as a commodity, like you're seeing gold valued at, for instance, then I could perhaps see a decoupling. But I think that a lot of the crypto market, as we get larger and larger, and, everyone on YouTube has been talking about they're coming, the institutions are coming. Well, I think you're starting to see what happens when the institutions come. It's not, the golden rainbows and Lambos that you necessarily thought it was going to be, because they're playing the game differently than, the majority of other people, or, that the majority of the retail dominated market that we've experienced so far, they're playing it different than these retail guys were playing back when the markets were much smaller back in 2015, 2016, right? So in addition to that, as the market cap goes higher and higher, I think you're going to see that if you want Bitcoin to get to these valuations that people talk about, 100K, 200K, 300K, the institutions have to come in. And they're operating under a particular set of, or, under a particular organization. And so they are valuing right now crypto as a risk asset, such as they would value, a tech stock. I think that's pretty clear that that's happening. And I kind of suspect that that is going to continue to happen into the foreseeable future, unless, something in the, unless the Fed pushes interest rates to the point where they start to break things in the economy, and then perhaps you see Bitcoin start to become valued in a different way. But I don't see a scenario where you're valuing Ethereum, for instance, in a different way than a tech stock, because, or Solana, or take your pick. What's that game that everyone plays? The we just talked about
Axie
it last.
Infinity.
Yeah, Axie Infinity. I don't see how that's valued differently than a tech stock is valued, because more or less it is that it's a company in charge of this cryptocurrency, and they're attempting to earn a profit, and they're attempting to make that particular network valuable. And basically what I'm getting at is, if it looks like a security, quacks like a security, it's probably a security. And so I think that's kind of how these institutions are sort of valuing these different cryptocurrencies. And I'm not implying Ethereum is. There's obviously quite a bit of decentralization there, but a lot of these others, I think that they certainly remain under that umbrella of being a security, or being a valued like a tech stock. What about you, Mark?
Yeah, I think those are great points. Yeah, and actually, one thing that's interesting about what you're saying is I actually kind of feel like there might be some utility then in differentiating between something like Bitcoin and the rest of, well, I say the rest of, but a lot of other crypto, because a lot of people kind of lump them together. They say, crypto is being treated like a tech stock or not. But I think what you're suggesting is there might be some, ultimately, as we go further, as the market cap of crypto, grows, there might be some differentiation that happens where maybe something like Bitcoin is more likely to decouple and act something a little bit more like gold. But then you have the things that are very much tethered to the economy, because I think that's really, with a lot of the altcoins, that's what they're trying to do. Ethereum's trying to do it, but then especially a lot of the other ones, they're trying to get to a point where they're serving some utility in the economy, where enough people are using them for whatever purpose, especially the ones that are trying to kind of market themselves more towards enterprise usage and adoption. The whole idea is that they're going to gain value because people are using them for some kind of utility. And that's kind of, as you were mentioning, utility, people will use things more in a booming economy. People will pull back on how much they're spending in a recession, in a shrinking economy. And so it seems like those kind of projects are very unlikely to ever uncouple from traditional markets, because they're going to be fighting for the same pie to some degree. They're going to be competing for some value that exists out there in the economy. They're just doing it in a decentralized way that does not exist, in some kind of centralized entity. But I don't see how they're ever going to decouple. But then something like Bitcoin, I think the argument is a lot more plausible to some degree. And so I think it's possible that we'll get into a point where there is that kind of differentiation that'll happen within crypto, where instead of crypto being treated as this one big monolith, because in some ways it's kind of silly to treat crypto as a monolith, because if you think about like stocks, for example, stocks as a category exists, but then within the stock market, there's energy stocks, there's consumer spending stocks, there's also healthcare, which won't go together. They're cyclical. Different ones will perform better at different times and have different strengths and weaknesses depending on what's going on in the economy. I suspect that crypto will be in a similar position at some point. There will be some crypto that'll perform better in certain market conditions than others. It'll probably become more diffuse, and we won't think about it as such a big kind of monolithic asset class at a certain point. That's just kind of my thoughts on that, I think.
Yeah. Yeah, I agree with you completely there. So we have another question from Mansas. He says, if DXY continues to move up the way it's going right now, will crypto head to a disaster situation? What do you think about that?
Yeah. Well, I'll let you take that one again also, since I was just just talking a bunch.
So, I think the reasons, well, let's put it this way. Historically, all indications seem to be that, yes, that would be the case. If when DXY is rallying, we've historically seen that risk assets tend to do very poorly. And so the question becomes, well, how far is the DXY going to go? And, we're seeing extreme weakness with the Euro USD, with the Yen USD, and so it's not so much I think that the necessarily the US dollar is showing strength. It's that its trading partners are showing extreme weakness. I think would be perhaps a better way to think about it. So I'm conflicted with this one in that all the data does seem to tell us that when the DXY is doing well, risk assets tend to do extremely poorly. However, at what point with the way that things are, at what point do people stop moving into the US dollar, and at what point there's a lot of what's already happened and what may happen, at what point is it priced in, I guess. And I think that's the $1 million question. If we knew that, then it would be much easier to react to the markets right now. But I think that there's just so much uncertainty out there that I think you kind of have to expect that the DXY is going to continue to show strength. And like Mark said, I think there's a certain benefit to posturing an uncertain attitude at the moment because of the fact that we just don't exactly know. Like, we don't even know what the Fed, what's inflation going to look like. And obviously, a lot of everything that's happening right now is going to hinge on that. If inflation started to come down and, the Fed were taking a less hawkish stance than they've been taking, then you might see the DXY start to retreat. But, if we come out tomorrow or, when is the announcement on the...
I think 2 days from
Wednesday?
now.
Yeah,
I think
Wednesday. Yeah, if it's another 75 basis point hike, I mean, at least for another month, I think you're going to be looking at, people sort of rallying to the dollar over a lot of what are perceived to be riskier global assets. And so long term, do I see that this continues? I probably don't think so. When we maybe start getting down to, and futures markets, if you actually take a look at these, the way that they're pricing the Fed funds rate, they kind of think that the Fed is probably going to be hawkish through the end of the third quarter of 2022, and then they're probably going to have to start backing things off. And so maybe that sort of is the impetus to sort of send the DXY retreating somewhat. But until that time, I think you're definitely going to see that this continues to show strength, and as a result, the risk assets like Bitcoin, like the rest of the cryptocurrency market, are going to show weakness.
Yeah, I agree. I don't have a whole ton to add. I mean, I think, like you were saying, Jay, the rally of the DXY is just kind of encapsulates a bunch of things that will just show a risk off appetite. The DXY kind of tends to just be a bit of a barometer of how much risk appetite people have, or at least the trend of the DXY. And as you were saying, a lot of it's due to weakness in other currencies, but it's also that part of that is because of all the kind of weakness in the global stage. A lot of those other currencies are having, if you look at what's going on with the euro right now, their inflation story is even worse than ours, and their central bank is just barely deciding that they're going to start to try to do something about it. So if we thought the Fed was behind the curve, the European Central Bank is even more behind the curve. So yeah, I don't really see it stopping anytime soon. I think the bigger question is, how will the beta between Bitcoin and the DXY hold up to the same degree that it has, or is there going to be a weakening of the correlation at some point when we've exhausted a lot of the sellers in crypto? And there might be still some more downside, but will it be as strong of downside as we saw coming off in November? I think that might be another question there. So switching gears a little bit, I saw that Manas also had a different question asking about the exchanges or different places that have now been going bankrupt, and basically a lot of retail money that's just gone up in smoke. So I'm curious what your thoughts on this are. So do you think that this is something that's likely to have a lasting impact? What do you think are going to be some of the fallout that will come off of this?
Well, I guess I kind of I look at this in a few different ways. First of all, I think you're going to see regulation come into the market now, and ultimately that may be a good thing, because obviously people can't be trusted because they're, they're going to, if they can get other people's money and gamble with it, they're going to do it. And that's been demonstrated now time and time again. Um, because, greed is always going to be out there. And to think that cryptocurrency is somehow going to be this utopia that sort of, that brings us all together, and that decentralization and that lack of regulation, you're going to have corrupt actors. Even if they're not intentionally being corrupt, they're going to be, at least greedy. And when something happens like this, and it probably always will, these things happen cyclically. And just imagine a scenario where these markets would have been allowed to, or suppose that the bull market didn't come to an end, and that we were at some of these, the cryptocurrency market is worth $10 trillion. And then this all happened. That would be a fucking disaster of epic proportions. Like nothing that we saw right now, where, the market got wrecked when the market cap was around $1.5 billion. Imagine that if this were coming off, the next market cycle where there were extraordinary amounts of money in the market, like the $10 trillion market cap. If it would have happened from there, then the ramifications, the regulation would already be here. Let's put it that way. And I think that would have been much worse for the crypto market. But given that, this happened sort of in a smaller environment, I think, relatively speaking, because the market cap, when all this kind of started happening, when UST hit, I think the total crypto market cap was around 1.5 trillion. So that's not chump change. That's not a small market necessarily, but I think that it could have been much, much worse than it was. And now if you want to argue, well, it may not have been able to happen because perhaps, bad actors were out there sort of attempting to crash the market in the way that they did. That's an entire different discussion. But, I still think that when you're operating in an unregulated environment like we just saw, this is going to happen every single time eventually. So in that regard, I think that there may be, at least in the United States and probably in Europe as well, and it seems like even a lot of Asian countries are trying now to regulate cryptocurrency. I think that it may not be a popular thing, but ultimately it is very likely to be a healthy thing for the market. What was the way the question was worded?
Oh, it was just kind of, what's the fallout? What are people supposed to do when?
Going forward,
you're getting locked up and all that.
I think, people, especially the retail market, they have a short memory, and so I do think that a lot of people won't be back for quite some time. But we've seen that from November 30th of 2013 through whatever arbitrary point you want to pick in 2017 or 2016, where the next bull run started. We see this a lot where the market gets absolutely wrecked, but guess what? They come back, and they come back in droves, and they come back exponentially larger than they were the last time around. And I kind of think that this is going to leave a bad taste in people's mouths for a few years, but ultimately that's what happens in these bear markets. A lot of people get hammered, and they get hammered hard, and then, it doesn't matter, because once they see the market doubling, tripling, quadrupling, people are up 10x, they're going to FOMO back in, just like I think they always do. What about you, Mark?
Yeah, no, I think those are great thoughts. I agree with what you said. I mean, the one thing that I think is interesting with all these centralized entities imploding is that one of the things that you can look at actually is DeFi protocols and how they've been holding up in this type of environment. And obviously we know that some of the more kind of sketchy DeFi protocols blew up, way earlier on. We had things like the Ohm forks. I don't know if you had followed those, or Ohm itself, Olympus DAO, which completely imploded early on into the bear market. Those are some pretty just straight up Ponzi DeFi protocols. Then of course UST Luna, which was kind of the catalyst that started all this. But if you look at kind of the more legit DeFi projects, your Aves, your MakerDAOs, et cetera, the ones that aren't promising and obscene crazy yields, that are much more reasonable, they've been fine. They haven't really missed a beat through all this, and certainly people aren't losing their life savings like they are on Voyager or potentially on Celsius, depending on what happens with that, or just any of these other centralized platforms. And a lot of the reason for it is that you're very much, on a DeFi protocol, you're limited by the code. You can't just go behind people's back and just gamble away billions of dollars of users' money. It's locked in there. You know where it is, and it's all transparent. It's all in the code. And so if anyone tried to propose a change to Aave that would let them do something like that, everyone would know about it and everyone would see it, and presumably they would vote against it. And so I think there's been a lot of people who've been trying to make the case in this bear market that DeFi is dead, that it's failed. I think this actually might suggest that it's not, that doesn't really seem to be the case. I think sketchy DeFi has failed and that's collapsed, but I think that was always bound to happen. And like you said, Jay, it's in these moments where you get the washout. And it's, in some ways in an unregulated market, you need these washouts because otherwise just all the crap, that just gets built up, all the people who are just merely in it for greed, not trying to build serious projects, are allowed to exist in a bull market, but then they don't survive in a bear market. And that's what really can then allow for strong projects to get built and to grow in that bear market to then catalyze the next bull market. And then just a final thought on regulation. I think I also fall on the same side that you're on, Jay, where it's not, people don't like it. People hate that the word regulation in the crypto space. But really, as long as it's not done in bad faith, and I think that's the thing that we have to be worried about, because certainly there are some regulators who just want to kill the whole thing and they don't really care. But I mean, at least early indications in the U.S., at least in the Senate, the Lummis-Gillibrand bill, it's fairly reasonable, at least in my reading. I mean, there's aspects of it that some people like more than others or dislike, but it certainly doesn't seem to be coming from a place of just trying to kill crypto outright. And if it does prevent things like this from happening, of the Voyagers or the Celsiuses or BlockFis, et cetera, from gambling away user funds like that, it might just mean that we're not going to be kind of stuck in this cycle where retail gets in, gets absolutely screwed, and then leaves for years, and then gets back in, gets absolutely screwed, and leaves. It might make things a little more stable from that perspective, which I think could be beneficial in the long term. And also just no one likes to see people lose all their money. I mean, it's just like, it's pretty horrible, and it's not ideal. So that would be kind of the way that I would see that. Is I think it will have a long lasting impact, as you said, Jay. A lot of people are going to be scared for a while, but then ultimately, I do think that when we're in the next bull market, no one's going to be talking about this, or when we do, it'll just be kind of, a lot of people won't have been around when it happened, or it'll be like Mt. Gox, where a lot of people will just say, oh, it's so long ago, they just don't think about it. It's not something that comes to mind so much. So I think that would be my kind of reaction to that, I think.
Yeah. Well, let's see. Who asked this? Renard Marquez asks, what's your strategy right now? Just simply put, how are you approaching the market right now? Are you kind of hands off, or are you actively investing right now, or are you just kind of waiting to? I know that you made that video recently talking about waiting to identify the trend before you sort of get involved.
Yeah, I think my personal strategy, and again, it's just me, so don't take this as financial advice by any means. But what I've been kind of thinking of is the downtrend hasn't broken yet, and so from that perspective, I'm certainly not dumping in heavily into the market right now, just because if we do see another 20, 30, 40% drawdown or more, then obviously that those funds are way better deployed down there than they are right now. So I've been kind of doing some DCAing, just averaging into strong projects, mostly Bitcoin, some other ones. But then really kind of, as I mentioned, once I start seeing signs of hope, so if we do see kind of a more bullish trend developing, and I, in that video, talked about some of the indicators that we have on the Upside Down data channel that I like to watch. Once those start flipping more bullish, then I'll be more likely to start deploying more heavily into the market, because I don't really care if I miss the absolute bottom. That doesn't really matter too much, because if you, let's say during the bear market in 2018, if you bought at 3,500 versus 4,000 versus 4,500, do you really care that much when Bitcoin rips up to 65K? I don't think people really. It's like, who cares? At that point, you're splitting hairs. You'd probably just be happy to have avoided any potential further drawdown, because it always could have gone that way. In the bottom of the 2018 bear market, there was nothing to say that 25 or that 3.5K had to be the bottom. It could have fallen another 50%, and then no one would have been, then everyone would have been talking about being sad about buying at 3.5. So that's where I think the benefit of kind of risk management, of making sure that you're not getting in too early and then just see the price fall away from you at 50%. That's just something I'm thinking of as maybe not being so worth it. But that's just my personal kind of approach. Jay, I'm curious to hear your thoughts on that.
Yeah, I mean, I think this could be there could be some foolishness associated with this, and again, the stupid quote that everyone has to say. I don't even know if you actually have to say this or not, but not financial advice.
Mhm.
Has anyone ever been sued on YouTube? I'd be interested to see those stats.
Right.
But I'm just doing the same thing that I kind of did back after the last bull run, which is as we go down, I'm dynamically dollar cost averaging, and it's kind of boring to say. I wish I had something real exciting and different to tell you right now, but it's kind of just what I'm doing. And just because it worked in the past doesn't mean that it's necessarily going to work again, especially as we're moving into new economic circumstances surrounding the market. It becomes certainly riskier. And this is actually something I was going to talk about in a future video, in that probably there's very likely a strong case to be made for, what I've been doing is dollar cost averaging once a week, but there's probably a strong case to be made for doing it once a month, or, at least once every 2 weeks or something, because ultimately, if you think the market's going to keep going down from here, then the fact remains that if you're doing it once a month, you're statistically speaking more likely to get in at a lower cost basis than compared to if you're doing it once a week. So with regards to how I'm approaching the market, with specific assets, it's Bitcoin is my number one. Ethereum, which I'm not a fan of, but I'm still buying it. That's my number two, and that's somewhere at around 25 to 30% my allocation, and then 5 to 10% or none, depending on the week. And this changes from week to week, are in altcoins. And currently, people will keep asking me what altcoins, and I'm buying Chainlink and Solana. But what I'll do with that, at least, is kind of shift that around as, so for the last couple months, it's been Solana and Chainlink, but I'll continue to shift it around, especially as the bear market goes on longer and longer. And as we move down farther and farther, then I'll start exploring perhaps riskier assets, because what we saw was, you can pick like the absolute most, the biggest shitcoin you can possibly imagine. If it was down 99%, there was a high likelihood that if you bought at that point, that you made a ton of money in this bull market, even if you had a fairly short selling window. But a lot of this stuff gets absolutely wiped out and then does rally, even if it has no use case, no users, no apps built on it, no network surrounding it. It still rallied in the bull market. And, that may not always be the case. And there may be some sort of maturation process in the crypto market where that isn't the case anymore. And I'm not suggesting to go out and buy shitcoins. But I think, if you just look historically, if you look from bottoms to the bull market, even the stuff that is useless had absolutely insane returns associated with it from the bottom. So I think there is something to say for looking at assets that you believe in, that have some sort of user base and have some sort of, at least if the fundamentals are something that you can make a reasonable argument for, and there's some sort of building going on around the asset and it's massively depressed, I think those are the kind of things I'll be looking at as we continue on further down. So specifically, one that comes to mind right off the top of my head is Avalanche. That's one, although there's, some issues surrounding Avalanche and, some of the decisions they made, but that's one in particular that I'll be looking at. And I'm actually looking more and more to get away from the layer ones, because I think that maybe not in the next market cycle, but eventually, I think you're going to continue to see this sort of, if I pose this question to you, what makes a good layer one? And you're probably going to tell me, secure, fast, and cheap. Well, as technology keeps improving, things are going to become faster, they're going to become more secure, and they're going to become cheaper. Well, if it keeps becoming cheaper and faster and cheaper and faster, that leads to sort of a spiral to the point where, well, where's the value then in that network? Because if it's so cheap that if I can have, as an example, Solana, let's pretend that the network, worked every day and weren't constantly going down. If Solana is so cheap that I can buy one Solana and pay all the transaction fees I need for the entire year, and this is a case I've made before, probably on the live stream, is, what is it that's so beneficial about owning Solana then? Because speculation at the end of the day will eventually dry up, and people will start to value the network for what it's really worth. And if it's cheaper and cheaper and cheaper to the point where you can pay your entire expected number of transaction fees with a single asset that costs you 25 cents or 30 cents or something, then you're going to have a tough time seeing these massive valuations for the layer one. So the value, like in the internet, where do you find the value at on the internet? It's in things like Google, it's in things like Amazon, it's in things like, just go down the list. And so I think that eventually, as the crypto market matures, you're going to see that same kind of thing play out, where the value is shifted away from the layer one, and it's going to be built, or the value will be coming from the apps built on top of the layer one.
So actually, I have a question based on that, because that is something that I've thought about, and there's something that's a little bit potentially concerning for these layer ones from that perspective. So I do agree with you that I think as the layer ones get faster and cheaper, it becomes harder and harder for them to kind of sustain themselves, quote unquote. They need kind of exponentially more and more people using them,
right,
for it to become sustainable, and that's questionable if that'll ever happen. And one of the things that's a little bit of a problem here is that because it's decentralized, it becomes a tragedy of the commons type situation. So for those of you who aren't familiar, tragedy of the commons is this phenomenon where if you have a bunch of people who are all collectively benefiting from something, so I think the case is often used is like farmers have a field and they can put cattle out, and the field can only handle 5 cows from each farmer. If everyone cooperates, only puts 5 cows out on the field, everyone's happy, everyone benefits. But then you have one kind of rogue farmer who says, screw it, I'm going to put 10 cows out there. And then, they do that. It hurts everyone else a little bit, but, they're kind of stealing resources from everyone else. Then what ends up happening is everything breaks down. Everyone else starts putting too many cattle out in the field, and then eventually it all just goes to waste. Because one of the things that I was thinking about with layer ones is that, if it is the case that layer ones can't sustain themselves from transaction fees, then you might argue, okay, well, then it would be the people using the network's interests to keep the network secure. So what you'd see is that these big D apps would then buy massive allocations of SOL, for example, and they would stake it because they want to make sure that Solana stays secure. So that's why they do it. But the problem with that is it's a tragedy of the commons, because how do you know that if it would be cheaper for your decentralized app not to have to do that? You would rather deploy those funds elsewhere to grow or whatever the case may be. You say, someone else will stake the SOL. I don't need to do it. Someone else is going to do it. But if everyone does that, then suddenly no one's staking because it's not, in their best interest. It's not worth it. And if the yield isn't as good, if the yield on the staked SOL isn't high enough to offset the opportunity cost of those funds elsewhere, no one's going to do it. And so that's another thing I think these layer ones are going to have to figure out is, in that kind of environment where there's no inherent there's no security from the use case of the network itself sufficient enough to secure it from a financial perspective, how the hell are you going to incentivize people to actually hold the asset? I think you're hitting the nail on the head, Jay. And I just think that I hear that argument is out there about, it's in the people's best interest to keep the network secure, therefore they'll do it. I don't really think that's going to happen, because that's just not human psychology. People are greedy, they try to get away with things, and they'll push it off onto someone else. So I do think that's a big problem, and something that they're going to have to fix going down the road. Now, another question I did have though, Jay, going back to what you were talking about with your strategy, and this is just a question I have that I'm very curious about your thoughts on, because I don't really have a great answer for it. So I do see dynamic DCAing as being a valid strategy. Like, I do think that it makes a lot of sense. My problem has always been with it though, how do you know the time scale to do it on, right? Because you have some fixed pool of money that you're working with, right? And so you could have this idea that I'm going to layer in at varying amounts, kind of as we go down. But the kind of X factor there is how long do I have to spread that out? Because that's going to change the nominal amount that I put in
Right.
at every stage, basically. So I'm curious how you think about that, because when I think about it, you could just base it on previous bear markets and say, well, if on average they've been about this long, I'll just kind of assume that's going to probably be about this time, and I'll do it. But I'm curious of your thoughts about how you kind of make that judgment of how to gauge the time relative to the relative weight, because it is kind of a two-dimensional factor that I think most people only ever talk about how you weight it. They don't talk about how to figure out the timing aspect.
Yeah. So, well, I think there's this isn't a one size fits all type problem, and you know, if you have a sort of an income stream, then it's not necessarily something that you need to be extraordinarily worried about. I think in that if you're allocating X percent of your income per month or per week or whatever it is to the investment allocation, which is kind of what I did back in like whatever 2018 19 and then into 2020. And so that's kind of how I always approached it. But then, when I came into the YouTube space, when I started making the model, well, then I kind of realized, well, you kind of have to approach things not to a one size fits all, because just because that's my situation, someone else may have, X amount of dollars. Let's call it. I always like to use like 100 or 1,000 or just whatever, just a generic amount of money. So let's say you have $10,000 sitting there and you need to then decide kind of how are you going to distribute that money over potentially a prolonged bear market. And so one thing that I've done is, and I'm sure you may have done something like this as well. Have you like looked at your risk model, the upside down,
Upside down potential indicator?
Yeah.
Yeah.
And determine sort of the percentage of time that the risk is in each individual risk band.
Right. Yeah.
So
for sure.
I've kind of done that and then said, well, if we have, I like to approach it as a worst case scenario. And for me, if the crypto market hasn't recovered 4 full years, like if we're not at least at some point making a recovery 4 full years from now, well, and if you're all into crypto, I think you're wrecked, and that's the bottom line. And don't worry, we'll all be wrecked with you. So, so I kind of look, if we haven't sort of made a recovery within 4 to 5 years, then there's something wrong. Something's not right in the market. And so the way I would suggest doing it is looking at that pool of cash that you have, trying to decide, first of all, will you have additional funds to sort of come in and back up that cash, or is that amount of cash that you have going to be it? And that's what you have for the next 5 years. And then sort of take, like I say, with the DCA index risk model, and this is getting into some technicalities now, but when you're at that 50 to 40, 40 to 30, et cetera, all the way down to 10 to 20, it tends to be that we're right in that 20 to 30 zone the majority of the time. So that would be for me, a 3x or 2.5x or whatever it is. And so I would then divide that by, well, if I'm going to have this set amount that I'm going to invest every week, and that's going to be X, so that's the 40 to 50 zone, I would then multiply that by 2.5 and then divide that by the total number of weeks that exist in a 4 to 5 year bear market, a worst case scenario. And perhaps you're sitting at home thinking, well, maybe that's not the worst case scenario. In my mind, that's kind of, if we haven't started to recover by that time, then something's up, something's not right. And, then that's a whole different issue you need to approach. But that's kind of how I would look at it, determining how much I have straight up and then looking at a worst case scenario and allocating it thusly. What about you, Mark? Oh, well,
yeah, that makes a lot of sense. Yeah, no, that's a very reasonable way of doing it. I mean, I also kind of think about it in a similar way, in that perspective is you just had to base it on something, and we're not going to have.
Yeah.
Oh, sorry. I think I might have just blipped out there for a second.
Oh yeah, I think I still see you.
Okay, good. I thought my internet had died there real quick. But yeah, what I was saying is I would think about it probably being about the same way. And so I think there's many different valid ways of doing it. I think that's a very a good way of doing it. I think other people have other approaches that will work. I did see one person in the chat said I'm keeping my preferred project secret, so I can let them a little bit. I mean, they're really basically the same as UJ, except I might add Polkadot to that list. I think Dot has some potential, being kind of one of the more prominent layer zero protocols that's out there.
Mark's secret project is Shiba Doge Inu
Yeah,
ETH Sol.
yeah, it's Shiba Inu poop coin. That's what I'm investing in heavily. One that I will call out though as being kind of a more random one, and I'm not advocating. Well, obviously, I'm not advocating to buy anything, and this is not one I'm touching until I think things are more bullish. But the use case is unique enough where I actually think this one could have some interesting potential, and that's a cash network. I don't know if you've heard of this one, Jay. It's basically trying to be like the AWS of a decentralized AWS. And the reason why this one's interesting is that a lot of nodes for different projects are actually run on AWS, which actually makes them kind of not decentralized, because
Right.
in times when AWS goes down, which does happen, it happened a couple months ago, then those projects are in a lot of trouble if their nodes are suddenly going offline. And so I do think there's going to be a demand for decentralized solutions for that, because people aren't going to be able to host it themselves or want to host it themselves. If they can do it on a platform like that, it might be a lot more useful for them. So that's one that I'm watching that could be, I don't know if it's going to work out or anything, but if it's around when the next bull run happens, it could be an interesting one to watch potentially. So that's just one I'm going to call out by name.
I think there's a really good question here, and I think I have an answer for it. So, are you familiar with the Mt. Gox, the Bitcoin that will be released?
Yeah.
So Philip asked kind of, what do you think when the Mt. Gox Bitcoin gets released? Could it potentially dump Bitcoin to 10K-ish? And so, I responded to him that I'm pretty sure they only have, less than 2% of the total supply or something like that.
Yeah.
And I think it's even less than that. And then he responded, well, when you look at how much 80K Bitcoin dumped on the market, dropped the price from Luna, Mt. Gox is 130K Bitcoin. And I think the distinction is that Luna dropping had systemic ramifications in the market, right? Because when Luna crashed, well, guess what? Now 3 Arrows Capital is crashing. Now Celsius is crashing. Now, et cetera, et cetera. All these different networks or all these different places where assets are being held they're kind of crashing alongside of it. And so you're getting sort of a cascade of liquidations. Whereas, I'm not going to sit here and tell you that 130 Bitcoin getting dumped onto the market instantaneously wouldn't be problematic. But I don't think that it comes with the contagion that Luna came with, because you had all of these different investors heavily into Luna. And so when that crashed, that Bitcoin had to get liquidated. But it wasn't just that Bitcoin, though. It was lots of other Bitcoin and lots of other Ethereum and then lots of other assets everywhere else that was also sort of getting sucked up into that tidal wave. I don't know if you agree with that, Mark, or...
Yeah, no, I do think that makes a lot of sense. That was certainly kind of, it was one of the things we actually saw in June. One of the signs of, this was separate from the Luna disaster, but it was a continuation of it, really. One of the reasons you knew that there was a lot of that forced selling going on was the fact that Bitcoin and ETH plummeted more than altcoins, that the altcoin dominance actually went up during that. And the reason was that, they needed to sell their most liquid assets, and that's Bitcoin and Ethereum. So you knew that was not a natural phenomenon. That was not natural market forces. One thing I will say about Mt. Gox specifically, and I don't know if this is really going to happen, but just one kind of counterpoint. I think a lot of people are assuming that the second that these people get their hands on their Bitcoin, they're just going to dump all of it to realize that profit. But one thing that people have pointed out, which is, I think, a fair point, is that these people have actually, they gave up on an opportunity for cash settlement. Like they said, I want the Bitcoin, I don't want the cash. They could have just gotten it settled for fiat. They decided not to. And so why would you do that if you didn't want the Bitcoin. So it just seems weird that you would say, no, don't give me fiat. I want to get my Bitcoin, then dump it for fiat. It
What were
just
the
seems a little
terms
bit.
exactly?
I'd have to go
I
back
don't
and look.
remember. Like
I
were they
recall that there
offered like
were.
current day market
Yeah, I
price
don't
or?
remember what the exact situation was or when that happened, but I do know that I think there are at least multiple times where they had the opportunity to take cash settlement, and they declined for basically gave up the opportunity cost to be able to get Bitcoin. If someone knows more specifically, feel free to throw in the chat here, but that's my understanding. And so it just does seem a little strange that you would say, no, don't give me that cash settlement, give me the Bitcoin so I can dump it immediately on the exchange. So certainly, I think some people probably will sell, but I do think it's a reasonable question to ask of will all of them dump, and I think that's probably maybe a little bit dubious. So that's one kind of thing I would say about that is, and the other thing about it as well is this is a known event, right? This is not a black swan. A lot of people are saying this is like the upcoming black swan. Well, it's not a black swan. Everyone knows about it. So there's probably been some degree of this that's been priced in the market already anyway. So certainly dumping more on the market could drop it, but it's probably not going to be the same as if no one knew this was coming and it suddenly got dumped on the market, that it might be a bigger black swan type of event. So those are just some thoughts that I have specifically about that event that's on the horizon and whether or not it'll be a big deal or not.
So Vineet asks, 2017 or now, which market has been more brutal and why?
Oh, that's a good question. I mean, I think it depends how you compare it, right? So I think if you're just looking at raw drawdown, then obviously 2017 has been worse than it is right now if you're talking about on the individual level. But if you're talking about it in terms of the aggregate, the amount of wealth that's been destroyed in the crypto space, this time around was way worse. We hit a market capitalization so much higher than we were in 2017. And I think that just means that so many more people have been wrecked than what happened in 2017. There's just more market participants in, and so you don't need to draw down as far to actually have more aggregate pain than what we saw before. And I think the other thing about it as well, I mean, I don't know, there's different things going on in 2017 as well, but I think this time around it caught people off guard because we had that double top pattern that a lot of people thought that the second we broke the all-time high, we were going to go off to another big parabolic run. And you can actually see this in long-term holder behavior. So long-term holders tend to be really good at identifying these kind of tops selling out. When you look at it, a lot of long-term holders sold out in the run going into 2021, but the number who actually got out in the actual all-time high in November was way fewer. You see this very muted spending by long-term holders, which suggests that a lot of people were just caught off guard. A lot of people did not see that double top coming and did not get out in time. And so I guess from an unexpected perspective, in some ways, maybe that was kind of brutal where 2017, I think, a lot of people just thought that was never going to end. The party was here to stay. We're going into some super cycle and the hype cycle was going, that kind of beautiful parabolic rally. I think a lot of people just thought that was going to keep on going. But I think more savvy people like the long-term holders saw that that wasn't going to happen. They got out. This time, I think a lot of people got trapped, which might be seen as being maybe a little bit more brutal. Just kind of off the top of my head, Jay, I'm curious what you think about that question.
Yeah, I think speaking to the long-term holders getting out at the December and January and probably some February of 2020 into 2021, and then not getting out to the same degree once we started to go from 29K up to 69K. I think a lot of that was because a lot of these long-term holders are sort of in a they're sort of in a different wealth category than what your average person has any sort of perception of, I guess, at this point. Because a lot of these guys now, they're worth, if not tens of millions, hundreds of millions of dollars. And so kind of the way that they're operating and the way that they're approaching the did we cut out here? Oh no, it looks like we're back.
Yeah, it looks
so,
like we're good.
Yeah. So the way that they're approaching their asset management, their asset risk management strategy, I kind of think that they had already, for the most part, sold, and we're talking about on aggregate here. I'm sure that there were some. That's not to say that none of these guys, none of these actors came in and sort of bought in huge during the dip and then sold as we went up. But I think on aggregate, they were pursuing an approach of kind of, well, they've already sold the assets that they have allocated or that they've sort of established that they're going to sell in the 40 to 50 to 50 to 60 range. And so the price wasn't different enough than what it was just at, you know, four or 5 months earlier, right? Because yeah, April to November. So I guess 6 to 7 months earlier. And so that's why you didn't see a lot of them sort of fleeing the market, because they are already, they're already sort of, they've already sold that allocated portion of their holdings that they're going to sell in that category. And so now they're just going to sit back and wait. And then, the $70,000 isn't enough to incentivize them to sort of flee out of the market or sell those assets at an increased rate than what they had already done 7 months earlier. So that's kind of what I think was going on there. And I think that's why you didn't see a lot of the long-term holders sort of getting out that second time around. Now, with that said, the question was 2017 or now, which is worse. And I tend to think that, bar none, 2017 was not, I think this was worse than 2017 because of the fact that, in 2017, you at least had relief rallies. You had 3 or 4, maybe 5 times where the price, nearly doubled, right? And if not more from wherever it bottomed out at. And so there was still activity and there was still some sort of, there was still a pulse. Now it's like, we've fallen off the cliff and all we're doing is falling and there's nothing else. There's nothing else in sight. And on top of it, you have just everywhere. You have people having their funds locked on these different, centralized entities that they have their funds, and it seems like many of them are never going to get those back. And so you may have had that to some degree back in 2017, or sorry, not 2017, 2018. But it was nothing like it is now. And, you've just seen, you've seen over $2 trillion wiped off the books in the last, since November. So we're talking 8 months now. You've seen $2 trillion, 66%, if not more, probably closer to 70% now of the total crypto market cap, just poof, gone. And probably 50% of that has come in the last 2 months, right? So this has been just unbelievable in the extent to which this has happened. Now, with all that said, I think back in 2018, and this is perhaps naive and perhaps going to get us absolutely wrecked, but back in 2018, there was fear that the crypto market never comes back. That was it. That was your chance. You missed out on the gold rush. You missed out on the Ponzi. Should have got out in December of 2017 because now you're wrecked. Whereas now I don't think people feel like that, but it's a common wisdom in investing is kind of go against whatever the herd is thinking. And so, that kind of gives me some concern that, maybe now is the time where crypto doesn't recover. Although, that's just kind of, I'm sort of talking to you guys from an emotional standpoint, which is something I very rarely do there. Trying to, saying sort of a fear that I have, a deep down fear, but because my intellect tells me that you have all these investors in the crypto market. It seems like there's all these good use cases for the market, and that it naturally has to recover. But combined with the fact that now we have this new set of economic circumstances that we're facing, I do have some amount of fear that the crypto market could, if it, when it does come out the other side, because ultimately I do think it will, that it's going to look different than it looks now. And it's going to be a facelift that not a lot of people like, is what my biggest fear is.
Yeah, no, I think that's that's a fair point. And I mean, one thing I will say, I have started to see some people say the exact sentiment that you were talking about there, Jay. With you missed it. These returns are never coming back. It's over. I got on crypto Twitter. But then, of course, when you go and you look at the replies, there's a lot of people dunking on them. So I think we might need to get more towards a point where all the replies are, yes, you're right. I agree. It's all over, et cetera, before we might be feeling more like we're getting to a bottom on the sentiment kind of perspective. I mean, I do think it's an interesting question about crypto recovering, because I think there's different ways that things could go that not necessarily people are talking about. Because I think people, when they think about this, they think about it in two ways. I think that crypto is just going to resume its, Bitcoin's going to resume its logarithmic growth curve, and nothing's really going to be a problem, or it's going to go to zero. And
Well,
I
it
actually
better,
think,
because I don't know what I made that log curve for.
right, yeah, yeah. But I do think one thing that we can look at as being maybe a bad comparison, but a comparison nonetheless, is something like gold or silver, where they had their crazy bull runs very early on when they started to be trading. If you look at their charts, it was back in the 70s when, right at the beginning, when gold and silver started to be trading in broader markets. And then they kind of just had their volatility, ups and downs, but they haven't really done any, neither of them has really gone on any kind of crazy bull run since. It's been more or less just kind of sideways volatility for their entire lives, with crazy volatility in between sometimes, but still kind of more or less range bound, especially silver. Silver is one that's kind of more or less just gone sideways. And so, it's not impossible also that crypto could see something like that, where, maybe this is the top of this bull run, of this decade-long bull run. We have a lot of pain in front of us in uncertain economic, non-conducive economic conditions. Then eventually we have another big bull run that kicks off later. I personally, that's not my base case. I think personally that crypto has a lot more utility or use cases than something like gold or silver does in a lot of cases. And so I do think that there's more possibility of the technology getting adopted to a point that it pulls things up. But who knows? Obviously that's just my thoughts. Anything could happen. But I do share the thought, and that's why, as you said at the beginning, me personally, that's why I would never even consider going all in on crypto, just because you don't want to be stuck in a point where you're wrong and you've lost literally everything. So that's just kind of my thoughts on that perspective.
Yeah. So someone's mentioning something here, and I just want to quickly talk about this because it kind of comes up as a joke often. And someone says, I bought fundamentals instead, and I missed the whole meme coin thing, and that's entirely fair. I do want to say though, if you especially the I don't know how to put this in a politically correct way, but the smaller of an investor you are, there's actually, I think, if you sort of do the math out on this, there is some element of, or there's some benefit to investing your money, at least a small percentage of it, into a highly risky asset like a meme coin. And when I say a small percentage of your portfolio, I'm talking about like 1% or 2%, something like that, and maybe spreading it out across a couple, because those assets do tend to have absolutely insane upside potential. And so to a degree, it's kind of like you're gambling a bit. But are you really gambling with something like Dogecoin, for instance? Because Dogecoin has outperformed Bitcoin since 2014. So I mean, I do think that if you're picking spots now, if you're FOMOing in during the bull run, then that's dumb. That's the bottom line. And you guys have, I'm sure if you're here in the live stream, you've watched my channel. This isn't like, I'm not shilling meme coins. I'm not, nothing like that. But I think there is an element of benefit to your portfolio and to the potential value of your portfolio. Because if you think about it, you're risking 1 to 2% to potentially 100x that 1 to 2%. And so if you lose, if you lose $100 or whatever 1% of your portfolio is, it's probably not the end of the world, especially in the crypto market. You lose 1% every, over the last 3 months, you lose 1% every 6 hours. So the benefit you're getting from doing that, especially if you're picking your spots and, we can talk about in maybe in a future video how to identify potential buying locations for different things. But if you're picking your spots and buying at reasonable entry points, I think there can be a benefit to a portfolio if investing a small amount into these much riskier assets. And now your argument may be, Joe, because you're kind of the one that said it there, was I bought fundamentals. The argument could be, well, I'd rather buy into a riskier asset with strong fundamentals. But the alternative is something like Dogecoin, something like Shiba Inu, for instance. That's another popular one now. They already have established, fans, like rabid communities that are formed around these assets that are now down 90%, 95%, or whatever it may be. And so there becomes it's almost this perverse thing where people say, meme coins are crap, et cetera, et cetera. But we always see that they're, unless you think that YouTube and Twitter and TikTok and all this Instagram, they're going away for some reason, which they're not, there's going to be an element of the cryptocurrency market that revolves around the meme coin industry. And so there can, in my opinion, be a strong benefit to sort of looking at assets like that to make up a small percentage of your portfolio, unless for some reason you have a moral aversion to them. And and then that's up to you. But for me personally, I don't have an affinity for any of these assets. I don't care about Bitcoin. I don't care about Ethereum. I don't care about Chainlink. I don't care about Solana. If I see a better opportunity in something else, I'll leave it like that and be on to the next thing, because I have no emotional attachment to any of these assets. And I think that is an underappreciated thing in the cryptocurrency market. Bitcoin doesn't give a shit about me. I don't give a shit about Bitcoin. I'm invested in Bitcoin because I see the potential in Bitcoin as an investment and nothing else. Same goes with Chainlink. And you see me talking highly about Chainlink all the time. If I thought for some reason Band Protocol were, offering significant advantages over Chainlink, I would leave Chainlink in a heartbeat and be invested in Band Protocol. So that's kind of something I think is important for people to keep in mind, is never fall in love with your assets, and don't be scared to look at other opportunities just because people talk shit about it on Reddit, whatever. Just because it doesn't necessarily have a use case doesn't matter if it's going to go up 100x in the next market cycle.
Yeah, I think those are great points. One follow up with the meme coin thing. I agree, and I think what you said with the picking your spot is especially important with those, because I kind of view meme coins as kind of just being like the hypersensitive to market sentiment assets, where if you catch them at the beginning of that bull run, then you can ride them. They're gonna have way higher beta. They're gonna go crazy, but then the second things start smelling off, they're gonna crash like crazy. So you have to be really, I think, on top of those. But I do agree that the R&R can be huge. I will also say, though, with those, that I think one of the other things that's difficult about them is that there's so many of them that can be a little bit hard to find the ones that, obviously if you go into like Dogecoin, Shiba Inu, those are ones that you can get, more modest upside, for meme coins, 10x, still no one's going to complain about it, but it's nothing compared to the 100,000x ones. I think it's when people start going way out in the risk curve and start going on to, Binance Smart Chain and just buy some absolute random garbage, that oftentimes that doesn't really work out. Yeah. So there's always that kind of,
you're literally gambling at that point once you're.
Yeah.
I agree. Yeah.
And so that's where like the expected value being the gains, but then also in there, the probability of actually achieving it. I think for those coins, the probability of achieving it gets so low that the expected value doesn't really come worth it. But for something like ones that are a little bit, well, if you use safe for a meme coin, those in which you catch them at the beginning of those bullish times are certainly going to be really strong. But I also just want to second what you said about, I actually want to make a video about this as well, this idea of not becoming attached or married, or really just becoming a tribalistic about your investments. Because that's really one of the things I think is dangerous about the crypto space, is that it encourages people to form communities around assets. You get people who really start to identify as a, HBAR person, a link person, or whatever. And then it's just going to lead them to ruin if those assets end up not panning out. And so that's why I always talk about, testing your thesis. If you have a thesis about an asset, don't just go out and look for information that confirms that thesis. Go out specifically and look for information that's disconfirming it. Because if it doesn't stand up, if you find so much information saying that you're wrong, then are you really convinced that you somehow magically know something that the actual facts don't, and that you're going to somehow beat the market when actually we know this asset is going to go to zero? And so that's just one of those things that for me personally, it's, every asset I hold, I'm always asking, should I be holding this? And if I can't come up with a good reason for it, then you just get out. There's no reason holding it another, 50% to the downside before you dump it. So,
but the key is do that before you buy it also. You can continue to question it, but I have a buddy who invests in cryptocurrency, and he'll buy something and then, oh well, this actually seems better, so I'm going to go chase that thing, and so it's a constant cycle of basically losing his money. Just chasing. He hears something on YouTube, watches one of these channels that they talk about altcoins a lot, and so he buys like whatever thing they're talking about on the channel every week, rather than, I guess he must not be a very good friend.
Yeah, right. Yeah. Well, I think he can beat your model, beat you.
Yeah. I mean, he's pretty much just a jerk for watching a different channel. So
I see. Yeah. Fair enough.
Yeah. So, well, guys, I think that's going to wrap it up. And thanks for joining us tonight, Mark. We were on for about an hour and a half, so I think it was a good conversation.
Thanks for having me on. This has been fun. Yeah, it's a good time.
So I want to tell you guys, whoever's left, make sure you go over to Upside Down Data. Honestly, and I really mean this, I'm not just saying it because Mark's here. I have him on the show all the time for a reason, and I really think that they are, they put out quality information, pretty much, higher end information than almost any other channel that you can find out there is putting out. So I highly recommend everyone go check them out and subscribe to their channel. And you can check out the content first. You'll see what I'm saying. It's all math and data driven. So that's going to be it for this one, guys. Until next time, as usual, see you.
All right. Take care, everyone.